Welcome back to the channel. Welcome back to the vlog. My name is Evan and this is Sense or Sense. And today I want to come to you to talk about a very important topic, taxes. One of the things I've figured out over the years is that I can trade and make a lot of money in the stock market, and yet I can also reduce my taxes almost to next to nothing or keep my taxes very, very low by doing a few key things. And today in this video, I want to talk about those things. Before we jump into the video, I wanted to thank you guys for tuning in recently. I'm very close to 500 subscribers at this point. I appreciate all the support. Please be sure to hit the like button and subscribe to the channel. Hit the notification bell if you find this information to be useful. Let's jump on into this and let's talk about this. So this is something that is in their tax code. There's no gray area. There's no, cheating the system or anything like that. This is simply a way of being able to essentially match your losses that you've had in your account for possibly years or short term with gains that you've had either recently, short term, or long term gains. And what this is called tax loss harvesting. And the concept of tax loss harvesting is something that some people utilize very effectively and others don't really utilize. And we get told by a lot of advisors and things like that, you should just set it and forget it, or they have a lot of churn in their portfolios because they're trying to make more money with your assets by getting you in and out of certain mutual funds or in and out of certain ETFs and things like that. I'm here to tell you that you want to be efficient with your taxation. Even if you're a trader, you can do so by effectively going out there, being strategic about when you sell gains, and then offsetting a lot of those gains with losses. And I want to talk about how I do this every single year in all of my portfolios, whether they're short-term, mid-term, or long-term. The nice thing is I've got multiple portfolios, and some of them have stocks that I've held for years, and some of them I just trade in and out of. And I have a few stocks that have been in there a long term, but mostly they're trades. I'm in and out in a couple months in some situations, and they're considered to be short-term capital gains. And so what I do is every year around October, November timeframe, I start looking at my portfolios and I start determining which positions I have that are down and which positions I have that are up. And then I determine which ones I want to sell and which ones I want to keep. And once I've made these decisions, I try to match the gains with the losses as much as possible. Now, you're probably saying, well, what if you just made a bunch of money in a given year and you don't have very many losses? Well, that can be an issue, and that I thought that was going to be the issue in 2025. However, I found a few positions that I've had in one of my longer term portfolios that were down quite a bit. I decided that I was going to let go of. I've held them for many years, and they just have been significant underperformers over the last several years, like a lot of stocks have been. And I sold those and took quite a bit of a long-term loss that I could use to offset some long-term gains that I have in some other positions. You might also be saying, well, what happens if you're a day trader or you're trading in and out of things very frequently? Well, yes, this is true. If you're making lots and lots of transactions for a positive gain, you may not be able to offset all those short-term gains. But I found that when you're trading options and you're especially doing cash secured puts, you can oftentimes offset some of those gains with some losses that you have when you have certain puts that go against you. Those are considered short-term losses, and if you're obviously trading in and out in a short period of time. As well as there are just some positions that you take in maybe in your longer term portfolio that you decide after 3 or 4 months it's just not working out the way you thought it was going to work out. I recently had a trade in PayPal that I thought I was going to hold on to PayPal for quite some time, and it just went against me quickly. I'm also in another position in John Hardy board, which makes the Hardy board siding for homes, and that's been going way against me as well. I plan on holding this for a long period of time, but at the same time, they're short-term losses right now. PayPal and John Hardy are short-term losses. I could use those to offset quite a bit of gains that I've already taken in trades that I've made this year that have been positive. And so before the end of the year, I'm going to have to make a critical decision on whether or not I'm going to sell those positions. And I don't have to sell out necessarily of all of it, but I might sell out of about half my John Hardy board, and I might sell out of half my PayPal and then just keep the other half. But there's a good reason why I might sell all of it, and that is, being able to offset those short-term capital gains with short-term capital losses saves quite a bit of money, and one thing a lot of people don't realize when they trade and they are getting long-term and short-term capital gains is that losses carry forward indefinitely. So if you happen to have a really bad year, it hasn't happened in a while for me. Thank goodness I've had really good years, much like the rest of the market has. But there was a time, 2009, 10 time frame where I had, thousands of dollars in losses that I didn't have any gains to offset. Well, I carried those forward for several years into 2014 and 15 and 16, and basically was able to offset most of my gains during those 2 or 3 year window right there with losses that I had previously. Another thing that most people don't realize is that if you have a capital loss in any given tax year, you can offset $3,000 worth of earned income that you have from your job with up to $3,000 worth of either short-term or long-term capital losses that will essentially save you on $3,000 worth of income tax. This is something that a lot of people don't realize as well. It can help you out with your taxes. It can help you move you down into a little bit lower a bracket if you combine that with other tax credits that you might be able to get, as well as it can just really help you in a situation where you might have had a bad year trading and or with your investments. So one thing critical to understand about long-term losses and short-term losses is that they have to be matched. In other words, if you have a bunch of short-term losses, they will be matched with long-term gains that you have and offset the long-term gains. However, it's not going to give you any additional tax benefit. So, you want to try to offset a lot of your short-term gains with short-term losses so that they match up and cancel each other out essentially for tax purposes. And then the same with long-term gains and long-term losses. It doesn't really benefit you as much if you take a huge amount in short-term losses and have a bunch of long-term gains, because you're not being exceptionally tax efficient with those being matched with each other. As a married couple in the United States right now, you can make under $106,000 in earned income per year and effectively pay 0% on your long-term capital gains. So if you're offsetting those long-term capital gains with short-term capital losses, that's not a very tax efficient way of doing so, because you're basically just, for that up until that 106,000, the long-term capital gains are not going to be taxed anyways. So there's no way to hold the short-term capital losses and say, I don't want it to go against the long-term capital gains, is what I'm trying to say. The IRS has a concept called matching, and that's what I just described. They're going to match those two together and effectively offset the long-term capital gains with the short-term losses. But if you can work it such that you have only long-term losses matched with long-term gains, and then you have additional $3,000 with the long-term losses, you can now offset $3,000 with your income. Also, as I said, it's not exceptionally difficult in some years to match the short-term gains with short-term losses. But understand that in some years it's not possible to do so, and you just have to be strategic about how you do it. So I don't want to ramble on and on about more of this, but essentially, this is the way that I'm able to make quite a bit in the markets each year and not pay any capital gains taxes. My wife and I generally are underneath that 106K each year by the time we take, our deductions and things like that. And that allows our long-term capital gains to be effectively taxed at zero also. That helps tremendously in this method of reducing your taxes via tax loss harvesting. There is one last thing I wanted to touch on, which is wash sale rules. You have to be careful when you sell something at a loss that you don't buy it back within 31 days afterwards, because you can get what they call a wash sale rule. That's beyond the scope of this video, but just understand this. The way I handle this is I don't buy the exact ETF or exact stock back. I buy something that's similar but different. So for instance, in the case of PayPal, I might look for an ETF that has a huge exposure to PayPal but isn't the same security, or I might look at another way of replacing PayPal in my account temporarily for that period of time before I decide to buy it back, if I want to buy it back. So these are the ways that I offset a lot of my gains and losses in the market. And so far in 2025, I am not going to be paying any long-term or short-term capital gains on quite a bit of investments that I've made that have been successful this year. So I appreciate you guys tuning in today. Thanks. Until next time, talk to you later.